Today, we are going to examine the structural competition between the Indian Rupee, Bangladeshi Taka, and the US dollar. The framing is not emotional or nationalistic, it is systematic. Currencies represent economic credibility, trade leverage, and geopolitical positioning. The US dollar dominates global finance while Bangladesh and India operate within the system. The key question is not which currency is stronger in isolation, but which currency has more control over flows of capital, trade, energy. This analysis will dissect the incentives, constraints, and the outcome of each currency regime. Currency valuation is not a cosmetic indicator, it is a compressed signal of power. A strong currency reflects capital inflows, institutional credibility, and geopolitical trust. The US dollar dictates pricing for oil, commodities, and debt. India and Bangladesh do not set these rules, they operate under them. The rupee and taka fluctuate based on how effectively each country manages external pressure. This asymmetry defines the battlefield. One player sets the system, the other adopts or absorbs the shock. The US dollar is not strong by accident. It is structurally embedded into the global system. Oil is priced in US dollars, international loans are denominated in dollars, central banks hold dollars as reserves. During crisis, capital flows into US assets, strengthening the currency further. This creates a feedback loop. Instability elsewhere increases demand for dollar, reinforcing US dominance. India and Bangladesh cannot escape this framework. They must accumulate dollars to survive external shocks. The Indian rupee is not falling, it is adjusting. India runs a persistent trade deficit, importing large volumes of oil and capital goods. This creates constant demand for dollars. The Reserve Bank of India intervenes selectively, using reserves to smooth volatility rather than fix the rate. This controlled depreciation helps exports remain competitive while preventing sudden economic shocks. However, it also means the rupee structurally trends downward over time against the dollar. The Bangladeshi Taka appears more stable than the rupee, but this stability is partly engineered. Bangladesh has historically used administrative controls and managed exchange bans to limit volatility. This suppresses visible depreciation but shifts pressure elsewhere: foreign reserves, import restrictions, and inflation. When the market rate diverges from the official rate, distortions emerge. Stability in this case is not strength, it is deferred adjustment. Foreign exchange reserves are primary defense mechanism in a currency war. India holds a massive reserve buffer, allowing it to intervene in markets and absorb shocks from oil price spikes or capital outflows. Bangladesh operates with smaller reserve base, limiting its ability to defend the Taka while sustained pressure. When reserves decline, governments must either devalue the currency or restrict imports. This is where structural weakness becomes visible. Energy imports create a direct pipeline of demand for the US dollar. When oil prices rise, both India and Bangladesh must spend more on dollars to secure energy. This increases demand for USD, weakening local currencies. The result is imported inflation. Fuel becomes more expensive, increasing transport and production costs. This dynamic is unavoidable unless a currency reduces dependency on imported energy or shifts trade settlement away from the dollar, which is structurally difficult. Currency depreciation is not abstract, it directly impacts daily life. A weaker rupee or taka raises the cost of imported goods, especially fuel and food prices. Business pass these costs to consumers, creating inflation. Governments may attempt subsidies, but this strains fiscal capacity. Over time, purchasing power erodes. The key point is that currency weakness is effectively a tax on consumption, disproportionately affecting lower income populations. A weaker currency is not purely negative, it enhances export competitiveness. India benefits from a diversified export base, including services, pharmaceuticals, and manufacturing. Bangladesh, on the other hand, relies heavily on garments, making it sensitive to global demand cycles. Controlled depreciation can act as a strategic tool, allowing exporters to remain competitive globally. However, over reliance on this mechanism can trap an economy in low value production cycles. Capital flows amplify currency movements. India, with a more open financial system, experienced significant portfolio inflows and outflows. When global investors withdraw funds, the rupee weakens quickly. Bangladesh, with tighter controls, experiences less volatility but also attracts lesser capital. This creates a trade off. Openness brings economic growth opportunities, but this also increases exposure to global shocks. Artificially stabilizing a currency creates distortions. It is if the official rate diverges from the market rate, parallel markets exist. Import restrictions may be imposed to conserve dollars, disrupting supply chains. Investors lose confidence in pricing transparency. Over time, these distortions accumulate, reducing economic efficiency, and slowing growth. Stability achieved through control often leads to instability elsewhere. The conclusion is straightforward. The US dollar dominates because it controls system, trade, energy, finance, and reserves. The Indian rupee operates through managed flexibility, absorbing shocks via market mechanisms. The Bangladeshi Taka maintains stability through administrative control but at the cost of hidden pressure. The real determinant of currency strength is not the exchange rate, it is the ability to control flows of capital, goods, and trust. On that metric, the dollar remains unchanged.